Hayes and Vonnie Quinn.
So, another record-setting day in the stock market yesterday, followed by a late August day of rest today. Is it time to hop on to a market that is heading for new highs, or is the bull run over for now? Here for a look at the markets, and as we're starting off the show, some of the latest market-moving news, and also to share the advice he gives his customers because he has many of them. David Edwards, he's founder, president, and portfolio manager, Heron Financial. Welcome back.
Good morning, Kathleen.
It's great to have you on the show again. As far as what is driving markets? Certainly, we're pretty much at the end of earnings seasons now. We've had the Fed out in Jackson Hole. This morning, we have Alibaba and its earnings, and that's, the excitement of IPOs and M&As has really been a big deal for the market this year. Quite apart from Alibaba and whether or not you would, recommend it to your clients, what about the role that M&A IPOs have played in the bull run lately?
So we're about 4 or 5 years now into a bull market, and a lot of commentators are already suggesting that that the bull market has to pull back because historically 5 years is the average. And we think that's a kind of a naive analysis. We're looking at a lot more decision points than just a couple of charts. It's nice to see that the M&A market is up a little bit. It's nice to see that the IPO market has increased. The question is this the sign of a bubble, or is this just business as usual? And our take, for a number of reasons, is that this is still business as usual. We don't have the deep discount in the stock market we saw in 2009 and in 2010, but we also don't have the extreme overvaluation we saw in 2000. By our parameters, which look at earnings and revenues and interest rates and inflation, the stock market is fairly valued. One of the factors that I think will allow this bull market to last longer than most is that the pace of recovery of the U.S. economy has been so slow. We describe it as having your car stuck in fourth gear trying to get from a stoplight up to highway speed. It just takes forever.
That's a good one. I love metaphors. That's a good one.
But because we've had such a slow acceleration, there's very little chance of overshooting on the far side. Inflation was running 1.5% last year. Now it's running 2%. Unemployment all the way down to 6.2%. That's still a long way from 3 or 4% where inflation might kick up.
So is it even a tired market? I mean, because by your analysis, it would seem like if the recovery has been this slow, when we eventually do escape, achieve escape velocity and grow, 3 to 4, 5%, we should see even more gains for stocks.
It seems reasonable that stocks will continue to grow. And the important thing that people seem to forget these days is that when you invest in the S&P 500, you're no longer investing in the U.S. economy, you're investing in the world economy. The U.S. economy grew 4.2% last quarter. The world economy is growing about 2.5%, 3% worldwide. American corporations, Pfizer, McDonald's, General Electric, are participating in the world economy and can grow their earnings indefinitely.
So we're looking at how long could this bull market last then? If not 5 years, how many years?
It will last until it ends. One of the hardest things to do is to predict the exact moment a bull market will break. There are things that we look for that indicate that we're on what we call thin ice. For example, overuse of leverage. We don't see that right now. We don't see that in margin lending, borrowing by investors. We don't see that in margin use by the big banks to leverage their portfolios. We look for speculative froth, people dumping their jobs to become day traders, like we used to see in 1999. That's not an issue right now. In fact, what we see is that so many smart, talented people are still 100% in cash 5 years after the market low.
All righty. Well, and another to Vonnie's point, the past secular bulls, some of them went a long, long time.
Yeah. Sometimes, the entire decade of the 90s, for example, was a continuous bull market.
All right, we're going to continue this conversation, just getting started with David Edwards, President, Founder, Portfolio Manager, Heron Financial. We also want to talk to him about a report produced by Heron, the 20th Annual Quantitative Analysis of Investor Behaviour, so stay tuned for that. We're speaking with David Edwards, President, Founder and Portfolio Manager of Heron Financial Group. He's been saying that the pace of this recovery has been so slow that this particular bull market could potentially last much longer than previous bull markets, and we're not really skating on thin ice yet. Some of the indicators that he looks at aren't really flashing any warning signals, and all of this M&A and IPO activity is good so long as companies are not over-leveraged, which he says they're not. I think that's a summary, basically, David, of the previous segment. Speaking of IPOs, this morning we're getting results from Alibaba, and the reason is because the roadshow starts next Wednesday. Profit tripled ahead of the IPO. They're IPOing about 12% of the company. Would that be, for example, something that you would advocate getting in on?
We have a rules-based approach to the kind of companies we will invest in, and Alibaba violates many of those rules. Well, first off, it's a company in China, not a company in the U.S., so we have to be very skeptical about their numbers. More importantly, when it comes to market, the price-to-sales ratio will be around 50, and the price-to-earnings ratio will be around 100. And we're almost guaranteed to not make money if we invest in that IPO. Google had similarly aggressive statistics when it first came out back in, 2006, thereabouts, 2005. And we held back from the IPO. The stock soared, fell back sharply, the valuations came into line, and then we were willing to invest. So we'll take a pass on Alibaba at this time. We'll take a look at it in a couple of years when it's a seasoned security.
All right. So because it's sort of like, I guess I can think of other types of investors, Bill O'Neill investors' daily approach. You don't need to catch the low. You don't need to catch the high. You just want to catch a stock that's moving higher. I'm thinking of Jim O'Shaughnessy's approach as well. He was on the show in the last couple of months, and he wants to find a lot of value. He has a list. When the stock gets too high up there and it doesn't have the value, he goes back to the bottom of the list and finds one for his clients that does.
Today, I can look at my list of stocks that I'm buying for my clients and find a solid drug company with a PE of 8 and a yield of 2.5%, and that's the kind of low-risk, base-hit type investment I make for my clients.
Now, tell us more about your clients and what they're doing, because the last couple of years, at least, David, when you've been on our show, you have talked about these really smart people sitting in cash and still not getting out. And it's one of those strange psychological things where, oh my God, I didn't get in and now the market went up, so I don't get in. And then it goes up more. Oh my, really didn't get in. No, it's how do you deal with that? And are you still seeing this with your clients?
We talk to two kinds of people. We talk to our clients, which are fully invested in an asset allocation strategy that enables them to live their lives with full knowledge that when push comes to shove, they always have the cash that they need. And then we also talk to prospects, and these are people that went to 100% cash in March 2009 and have watched the market triple over the last 5 years and refuse to take action to invest for themselves because they know that the second they invest, the stock market is out to get them and it will immediately crater on their behalf. And that's not rational. And how do you explain this? These people are brilliant. They're CEOs of Fortune 500 companies. They're presidents of colleges. They're managing partners of law firms. They are very smart, talented, highly educated people. What holds people back from being successful investors is what we call your lizard brain. Deep in your brain is the part of your biology that kept you and your ancestors alive for the last billion years. And so if you were a caveman 10,000 years ago and you saw a saber-toothed tiger, you ran like crazy because those that didn't died. And now people look at the stock market as a saber-toothed tiger, and they got burned once, and they will never go there again.
So you're saying this is truly one of those kind of unconscious, pit of our stomach, tightness in our chest kind of emotional reaction when we think about stocks and money, as opposed to an intelligent, quote-unquote, objective decision.
Absolutely. I've been talking to one guy for 5 years now. He's a Fortune 500 CEO. He's got $25 million in company stock, $25 million in cash. That cash is spread across 25 banks, so he has FDIC protection no matter what. And I say, don't you ever want to get some of this money invested? He goes, no, David, no matter what happens, I will always have cash, and I'll never need to worry about buying groceries. Really?
So what areas then of the market, David, are you most interested in at the moment?
Well, we take generally a broad asset allocation approach. So we've got U.S. stocks, international stocks, and emerging markets, and commodities, and real estate. 21 years ago, it was super critical for me to beat the averages. I thought that was my job. Now I've realized that delivering relatively stable, relatively reliable returns is all my clients need to enjoy their retirement. So, for example, every year we get a copy of the Quantitative Analysis of Investor Behavior. It's published by a research group up in Boston called Dalbar. And I love this quote from their latest issue. Attempts to correct irrational investor behavior through education have proved to be futile. The belief that investors will make prudent decisions after education and disclosure has been totally discredited. Wow. Statistically, The market grew 9.2% a year from through the 20 years through 2013. The average investor only received 5%. What's the difference between 5% and 9% over 20 years? It's the difference between doubling your portfolio over 20 years versus quintupling your portfolio over 20 years.
David, are you saying then that it's not so much an individual part of the market that you like now as it is an allocation among various kinds of assets, various parts of the stock market to achieve some kind of steady, stable return?
Yes. 20 years ago, I could see that my hard work picking stocks increased my clients' returns by 20%. So if the market returned 10%, they would get 12%. These days, because of the rise of the ETF market and the index fund markets, I can see that my hard work is only adding about 5% incremental return. At that point, it's not even worth bothering. What's more important is making sure we have the right mix of stocks, the right mix of bonds, and the right mix of cash to address the issue of risk we care about, the chance money won't be there when you need it.
There you go. David Edwards, Heron Financial. Actually, we want to talk a little bit more about his life prior to becoming a wealth manager, working at some of the biggest firms on Wall Street. So he has a perfect kind of perspective and history to talk about what you need to do with your money. This is the Hayes Advantage, Bloomberg Radio. Let's get back to our look at the stock market from the perspective of a wealth manager, someone who has a real live client just like you, whose money he manages, to whom he gives advice. David Edwards is our guest. He's president, founder, and portfolio manager at Heron Financial Group. And Dave, I wanted to start by asking you to lay out for us your career on Wall Street prior to becoming a wealth manager, because I think all those years you spent sort of on the institutional side, the big firms, really informs your perspective and how you manage money today.
Sure. I began my career at Morgan Stanley in 1983 in systems, at a time when computers were being brought to bear for the first time on financial applications. And at the time, Morgan Stanley had 2 floors of 55 Water Street full of computers. I believe that the iPhone in my pocket has more processing power than all of Morgan Stanley in 1983. Within a year, I got pulled over into fixed income, working on mortgage backs when mortgage backs renew, CMOs when CMOs renew, swaps when swaps renew. Later, I worked at JP Morgan Bank on some of the first value risk models. And the takeaway from all those years of working with computer systems was the recognition that you can quantify things as much as you like, and then something will happen you never thought of before. For example, many value risk models in the mid-2000 time frame that were looking at the housing markets did not allow you to enter a negative number for housing prices because no one had ever seen those before. And when push came to shove, those value risk models weren't worth anything. So when we do our strategic review, our strategic analysis, we don't look at any one data point. I hardly even look at the market on a day-by-day basis anymore. I look at about 30,000 data points over the last 6 months and think about 10,000 more over the next 6 months, and let those data points be like tiles in a mosaic. If I get enough of them, eventually a pretty picture will appear. And so right now, we look at the commodities market and we see it as neutral. Prices are neither rising nor falling. We see Fed policy neutral, probably will go bearish in a year or two as they start raising rates again. We see the economic reports as neutral turning bullish. 6.2% unemployment, under 5. That would be very good. We see housing prices at the level now where most people are no longer negative on their equity. Housing equity matters much more to average Americans than stock equity. We see politics as a very red, very bearish indicator right now. If there was ever a case to be made for term limits, this Congress has made that case. And so we see an enormous opportunity to borrow money at very low rates for 30 years and use it to rebuild American infrastructure, and that opportunity is being squandered because of people in politics.
So, and given your outlook, would you avoid sort of, getting into anything that might be attached to potential infrastructure products or
No, because
projects?
There's still plenty of infrastructure taking place. There's plenty of construction going on right here in New York City. It would be nice to see some highways being rebuilt, some bridges being rebuilt, but the U.S. economy is like a giant aircraft carrier. It just rolls, and you can throw some waves against its bow. It will not stop for that.
Okay, so let's, again, you have a balanced portfolio approach. You look at stocks, bonds. You just gave us a terrific list of where the pluses and the minuses are. So if someone's listening and they have some money and they like to do it themselves, where would you advise them to look first right now? Where should they be putting the ballast, the weight of their portfolio?
The question they answer before they answer the investing question is, what is the purpose of this money?
Let's say it's to make it grow so they have more money in retirement.
So let's say this is money is for retirement. It's 15 years out from now. You can go 100% invested in stocks for a 15-year need. I love babies. Babies should buy stocks on margin. They have 50 or 60 years before they need that money.
I see a new line of business for you, Dave.
But if you're 5 years away from retirement or in retirement, you can't have that kind of portfolio. You need to scale back to, let's say, 70% equities and 30% bonds.
Now, you said commodities are going nowhere. Does that mean you don't even have a portion in commodities?
No, we always have about 5% of our investments in commodities, and commodities are very volatile. So let's say our allocation is 5%, and all of a sudden we have a rally in the gold market, and it's 7%.
Okay, so then how do you decide? Let's say if I said, David, energy, financials, consumer cyclicals, consumer staples, large cap versus small cap, where would, first of all, specifically, where would you put your weight now, and how do you make that decision?
So here we are in economic expansion is becoming mature. And so at this stage of the game, the small cap stocks can do very well because there's plenty of cash flowing. As we head into the next contraction, those small cap companies will become a lot less attractive, and we'll scale back there. Within specific sectors, technology versus healthcare versus finances. In different parts of the economic cycle, those sectors will shine. When the economy is expanding rapidly, technology does well. When the economy is contracting, healthcare does well. The demand remains the same, money flows out of technology into healthcare. So when you establish tolerance bands for your asset allocation, and you find that technology is now overexposed, if you automatically sell a portion of that and reinvest it in the underperforming sectors, you are obliging yourself to sell high and buy low. What most people do is they say, hey, technology stocks are doing really well. I'm going to put 100% of my assets there, as they did during the internet bubble. Or they see that real estate is doing really well, so they put 100% of their assets there, as we saw in 2007, and then they're shocked when it goes really badly.
All right, we're going to continue this conversation. David Edwards is with us for the next segment as well. He is with Heron Financial Group. We're speaking with David Edwards of Heron Financial Group. We want to ask him about fixed income in a second, but I do want to ask you, David, since it's so pertinent, about geopolitics. You said, that you don't really look at the markets day to day and what they do, and you've got about 30,000 data points that you keep an eye on, another 10,000 for the future. Does something like a conflict breaking out in eastern Ukraine or Gaza, Israel, does that...
Our clients have called us and said, hey, Dave, what about the situation, in the Ukraine with Russia? Should we be concerned? And our response is, it's a second world country beating up in a third world country. It's a humanitarian crisis, but it has no economic impact on us whatsoever. We saw a brief spike in oil prices when the whole Middle East went up in flames about a month ago. Gaza Strip, Libya, Bangladesh, Pakistan. The whole Arab world seems to be on fire right now.
If this were to drag the U.S. into a different kind of foreign policy, is that the point then where you say, okay, let's look at our allocations, let's see how this would affect defense spending, let's see if it might affect those kinds of things? But do you wait for something that's more big picture?
We need to see more information, but let's not forget that in the last 15 years, the U.S. went through not one but two major wars in Afghanistan and Iraq, multiple minor wars, and yet the economy is at a record level. So it's important to keep that perspective that a humanitarian crisis does not equal economic crisis, does not equal a stock market crisis.
Final,
Go ahead, Vonnie.
Final question, fixed income, 2-year yield at 0.51, 10, 2.38, so we're getting a flattening curve. What would you do?
We know that the 10-year Treasury has to be at 4.5% in a couple of years because that's where it was in 2007, right before the whole current crisis occurred. So when we look at our bond exposure, we keep our maturities relatively short, 3 to 5 years, but we don't mind going down in credit quality. In my mind, the riskiest bond out there right now is a 30-year Treasury zero-coupon bond, which is very sensitive to interest rates. What's not risky to me right now is a junk bond with a coupon of 5% and a yield of 3 years.
Okay, and here's the truly final. I'm just asking part two of Vonnie's final question. The European bond rally, it's crazy. You've got, the 10-year Bund under 0.9. You've got the the Italian 10-year trading under a 10-year Treasury.
Yep.
Would you touch that with a 10-foot pole?
Europe now looks very much like Japan. They're stuck in a 20-year economic malaise, and they don't know what to do to get out of it. And that's why interest rates are so low.
All right, David Edwards, thank you so much for giving us so much of your time today. Heron Financial President, Founder and Portfolio Manager.